Hello and welcome to today's video. My name's Jeff. I'm the founder of Emerald Power, and today I'm going to be talking to you a little bit about carbon reporting, what it is, who's it for, what are the buzzwords, what are the things you need to know, how do you report on it, and pretty much everything in between. So hopefully after today's video you'll have a better understanding of what carbon reporting is and ultimately how it works. So, what exactly is carbon accounting? So, carbon accounting is the process of measuring, tracking, and reporting on the amount of carbon dioxide you as a business emit into the atmosphere. It is also not only just important to report on the amount of emissions that you're emitting, but also in showing how much of that you're actually removing from the atmosphere as well, in terms of any carbon offsets that you have and also any positive initiatives that you're implementing within the business in order to reduce your environmental footprint. Many people often think that carbon accounting is about showcasing the bad and the ugly within your business, but it's actually also about showcasing what you as a business are doing and the good work that you're doing in terms of reducing your overall environmental impact. And that's essentially what carbon accounting is. It's about weighing up the odds and showcasing that you have a plan in place to help reduce your carbon footprint over any given period of time. So, why is this important? Well, as it stands, there is legislation coming down the line for every business over the next number of years. And this legislation will require all companies of all different sizes to report on their carbon footprint by law. So there's many legislations out across Ireland, the UK, Europe that are affecting a large number of larger businesses, but they also have an impact on smaller businesses who might be doing business with those larger corporations. So there is regulatory compliance coming as well. In terms of why it's also important is risk management is a big thing. So carbon accounting is a way of mitigating your business against potential risk of losing business, losing customers, losing investment, losing loans. The amount of companies and stakeholders now that are asking for sustainability reports is crazy. It's become a very well-known strategic play in business now to have that readily available. And potentially not having a carbon report or a sustainability report available, it means you're limiting yourself as a business in terms of potential growth. The cost savings associated with carbon reporting and carbon accounting are huge as well. It's a fantastic way to see where are your emission hotspots and also work towards reducing your overall carbon footprint, which in turn will help you save money, reduce energy consumption, and make your business much more efficient as well. Also, as I mentioned there, many investors and customers are now expecting companies to be greener. Green is the new black. It's sexy to be green. And it's important to be able to showcase what you're doing from an environmental impact across the board, from sustainability to ESG, right down to governance. Also, carbon accounting gives businesses a competitive edge over those who aren't. So, especially if you're applying for the likes of any tenders, and rather than you just going in and saying how great you are in terms of that you've put solar panels on the roof, you've planted X amount of trees, you've put, implemented paperless into your business. That's all well and good, but you will be beaten by the business who goes in and says, "This was our carbon footprint in 2022. This is the initiatives that we've implemented, and this is how we've reduced it in 2023. So carbon accounting gives you tangible evidence behind the good work that you're doing and really allows you to showcase how committed you are towards sustainability. And as well as that, like, it's just all about future proofing your business. There is legislation coming out all the time. It's always constantly developing, and you as a business need to keep up with that in terms of future proofing your business as much as possible. So, who is carbon accounting for and who needs to start doing it? Well, as it stands, this year was first introduced. EU businesses that fall under CSRD need to begin carbon accounting. And what that means is businesses that meet two of the three following criteria. They either have a turnover exceeding more than 40 million, they have a balance sheet totaling exceeding more than 20 million, or they have more than 250 employees. If they meet just two of those criteria there, they then have to start reporting on their carbon footprint. If, for example, you are a small business or a mid-market business and you do business with large corporations who fall under CSRD, you actually fall into their supply chain, and as a result, you will be indirectly impacted by CSRD. So what that means is even small businesses who aren't actually directly impacted by CSRD, they will now have to start reporting on their carbon footprint as well. So there's various different types of emissions. So it's divided into two groups. It's direct emissions, which are activities that your business controls. So for example, any fuel that you are burning on site, that would count as a direct emission. And then there's also indirect emissions, which would be activities that support your business's operations, but are completely outside of your control. So example, this would be everything that you purchase in related to sold goods and services. So carbon accounting is specifically divided into three different scopes under the GHG protocol. So there's scope 1, 2, and 3. And what they are is they're essentially different categories for you as a business to measure your carbon footprint. Scope 1 is direct emissions. So these are emissions that are directly coming from your organization as it produces it from the sources that it's owned. So for an example of this could be if you own a fleet of company vehicles and they run on diesel or petrol, they would fall under your scope 1 emissions because you are burning them directly as a result of your business conducting operations. Another example of this could be any diesel generators or engines that you have on site in order to run operations. Again, it's fuel that's being consumed on site and therefore falls under your scope 1, your direct emissions. Scope 2 are indirect emissions. And what this means is it's essentially any emissions that you purchase, such as energy or steam or heating that are used to power, heat, or cool a building that you own. So an example of this would be electricity that you purchase from the national grid. These would fall under your scope 2 emissions and these need to be accounted for. Scope 3 are indirect emissions again. So scope 3 is where it gets a little bit more complicated, as these are indirect emissions through your company's value and supply chain and are often not directly controlled by your company. Scope 3 is very often the largest emission source for many businesses and also the most challenging to measure due to the complexities of data and the sheer volume of that data as well. An example of this would be any types of purchased goods and services your business makes, any waste that is generated in operations, any business travel that you use to maybe fly over to the UK for a meeting or drive down the country for a meeting, you need to log that. And also any employee commuting and supply chain operations would all fall under your scope 3. So it is a huge category for businesses and often the most difficult one to measure. So how do you use this data once you collect it and what's the point of it? Well, the data is used to generate compliance ready reports. So when you collect all your data across scope 1, 2, and 3, you are able to generate compliance ready reports. This in turn will allow you to showcase what you're doing from a carbon reduction standpoint and show how the initiatives that you've implemented into your business are having a positive impact on your environmental footprint. As I mentioned before, it's going to give you that competitive advantage over others who might not be doing any carbon reporting. This is very much applicable, especially if you're trying to win new business, apply for loans, or win investors over. It's so important to have this data to hand and being able to back it up with tangible evidence and numbers behind your sustainability efforts. It goes a long way. It also means that you're taking a more proactive than a reactive approach to it. So having this data readily available rather than reacting to it when an investor or a stakeholder or a potential customer asks for it, it's so much better and so much easier because this can take a couple of weeks to get up and running. And as you probably know, if you're trying to win deals, trying to win investors, trying to get loans, time is money and you need to have this data readily available. Acceleration is the key here. Sustainability compliance is coming. It's going to be a legislation that comes out. You will be required to do this by law. So it's good to start building foundations now, have it implemented. So when it comes to your time of reporting on it, you're not scrambling to gather all this data in advance. So how do you get started? Well, the most important thing is to build a strong foundation here when it comes to carbon reporting. So implement a streamlined system to help this data collection and make your job a little bit easier. Carbon reporting is no easy task. It requires a lot of hours, it requires a lot of organization, and it requires a lot of data in order to make the actual calculations off the back of it. Please, please, please do not use Excel sheets. They are not an efficient way of reporting. They are lathered with potential problems and issues, and just the sheer volume of data, the different formulas, the different units of measurement, it's not worth the hassle and the headache. You as a business need to identify then what scopes actually apply to your business. So we've listed off scope 1, 2, and 3. There's a numerous different categories under each scope, but not every single one of them will apply to your business. So it's important to speak with someone to find out which scopes are actually relevant to you. Then you need to collect the data from those various scopes. The data collection in itself can be a mammoth task, but having a system in place like a software that can streamline that data collection, it makes life so much easier and eliminates the potential risk of human error and also reduces admin time as well. Once you have that data entered into the system, and then you're able to generate audit ready reports in line with reporting standards. Now that you have that information readily available, you can then start to take action and set targets. It allows you then to actually focus on what matters in order to reduce your carbon footprint and how you can go about improving it over time. So what I always recommend to people is build the right foundation. And what we've done is we've developed a platform called Emerald Power, which helps businesses streamline their entire carbon accounting process. So with it, you can streamline the entire data collection process by reducing admin time and also reducing the fact that it could be prone to human error. All the emission factors and formulas are built into it, which are in line with the GHG protocol, ensuring that you're getting the most accurate results as well. And obviously the GHG protocol is a globally recognized reporting standard. We also have reporting functions built into our platform as well to ensure that you're generating audit-ready reports that really showcase the good work that you're doing. And as well as that, you can also identify any emission hotspots within your business. You can also set reduction targets through our portal as well, ensuring that you can focus on setting positive reduction targets for particular different scopes. For example, it could be maybe you want to look at reducing your electricity over the next 20 years, maybe bringing it down to 51%. You can set very specific targets within our platform. And essentially what it does is it accelerates your ability to become sustainability compliant and ensures that you are audit ready, you're prepared for CSRD, and your business isn't going to suffer as a result. If you have any questions on today, please feel free to shoot me a message and I'll be more than happy to help. Thanks for listening.